Gold is back below the $3,300 mark, with bears taking the upper hand. Does this mean a short-term breakout is off the table, or is there enough conviction to bet on a one-way slide? Find out more in this week's As Good As Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. So over the past week, gold's upward momentum hit a wall, with bears taking control. A series of developments ranging from the House passing Trump's sweeping tax bill, shifting rhetoric on European Union tariffs from the White House, resilient US data, and changing market sentiment help explain the recent shift in price direction. Looking ahead, US Treasury auctions and the core PCE data later this week could stir short-term volatility. Well, now, if we take a quick look on the gold against US dollar daily chart, the turning point was clearly last Friday. Before that, bullish momentum was quite strong, with prices touching April highs intraday and closing the week nearly 5% higher. But this week, sellers pushed gold back below the 61.8% Fibonacci retracement of the May downtrend, hovering near the $3,300 mark at the moment. If prices fell to close above $3,317 today, the 50-day moving average and the mid-April low around $3,170 could offer some support, while on the upside, $3,430 remains a key resistance zone for bulls. Well, Trump's One Big Beautiful Bill passed the House last week, reigniting concerns around the US debt and physical sustainability. Meanwhile, tariff uncertainty came roaring back. Trump floated a potential 50% tariff on European Union imports and a 25% levy on non-US iPhones, renewing haven demand for gold. With gold now retreating, traders are facing two main questions. The first one would be, has this rally run out of steam? The second one is, are we about to see a one-sided drop? Personally, I think gold is still more likely to stay range-bound in the near term. Directional clarity may remain elusive for now, at least. Well, for bulls, trade optimism and resilient US data have made it tough to long aggressively. On tariffs, the White House pushed the start date for new EU levies from June the 1st to July the 9th. And more notably, White House advisor Hassett said tariffs could go to 10% or less for some countries. A quite surprising shift for me, to be honest, considering Bissett and Trump had previously framed 10% as a floor. In other words, it looks like the US may be backing off a bit on the Europe, easing risk sentiment and keeping gold demand. While at the same time, the latest US data printed a mixed yet broadly supportive picture for risk assets. Consumer confidence rebounded strongly, and while durable goods orders fell 6.3%, the decline was slightly better than expected. Treasury demand held up well too, with yesterday's two-year auction showing decent interest. Yields dropped across the curve, hinting at renewed appetite for duration. While usually falling yields would support gold, but what's really interesting here is that the dollar actually strengthened as well, suggesting markets are shifting focus towards improving sentiment around the US economy, largely driven by easing trade tensions. That's a headwind for gold, obviously, especially with the Fed likely to remain quite cautious. That said, it's not all bad news for gold. With the US debt redemption peak coming up in June, any lack of clarity from the Trump administration on fiscal direction could jolt markets and drive safe haven demand higher again. What's more, the market already seems to be pricing in some roadblocks for the tax bill in the Senate. The proposed Medicaid cuts will likely face opposition, potentially making the final version even more expansionary. If it passes, short-term concerns around the U.S. deficit could intensify, and once the tariff pause ends, that may introduce more policy uncertainty, possibly forcing the Fed to reassess its rate cut path. In such a scenario, gold will likely find a floor. So in short, gold's bullish trend from mid of May appears to have stalled, with prices coming under pressure from improving risk sentiment, solid U.S. data, and easing trade concerns. But still, lingering uncertainty around fiscal and tariff policy could support a bottoming process. For now, I continue to expect gold to trade in a broad range between $31.70 and $34.30. As we look ahead to the rest of the week, keep an eye on US Treasury auctions and Friday's core PCE inflation print. Strong demand at the 5-year and 7-year Treasury sales, along with further declines in long-end yields, could sap safe haven flows into gold. And as for inflation, the market expects April's core PCE to ease from 2.6% to 2.5% on a yearly basis. If it does, that could offer a modest boost to gold. And obviously, any updates on the tax bill and tariff talks could move the needle. So that's pretty much all for this week. If this video is helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data and events might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!